Valens Research, Uniform Financial Analytics.
Albemarle is a lithium mining company. They call themselves a lithium mining company. Really, in reality, because the way that you make lithium is you extract it out of basically out of salt, and most of their operations are in Chile. So it's more of a chemical company than it is a mining company, quite frankly. But when we look at Albemarle, what we see immediately is a couple things. One is this company has historically been way more profitable than as-reported metrics show it has been, right? On an as-reported basis, for the last couple of years, you think returns have been around 5%. For most of that period, they've been around 13%. But we see another thing that's really important. On an as-reported basis, it looks like Albemarle, it has been basically had flat to strong return on assets. In reality, return on assets has been cratering the last couple of years, and that's really important when we look down below at PE, at a uniform accounting versus as-reported PE. You'd pay a 24 times multiple, right, which is what the market, what investors looking at as-reported metrics think they're paying. You would pay that kind of multiple for a company that had improving returns, was growing, it grew at 30% last year, and also had a massive tailwind for the business because of the fact that it makes lithium, and lithium is essential if we're going to move more and more towards EVs, right? Electric vehicles. If Tesla is going to continue to have booming production, et cetera, Albemarle obviously should be a winner. What reality is going on, though, is you've got a company who it and its peers have massively overinvested, expecting a bigger expansion in EV demand and lithium demand, and because of that, returns have fallen. Well, the company is trading at a 40 times adjusted PE. This is not a company that is super cheap, that is reasonably cheap, that has ROAs that are actually robust. It is a company that is incredibly expensive and has ROAs that are cratering. Very different understanding of what's going on with this business when you look at the distorted as-reported metrics versus if you look at uniform accounting reality. And that changes how we think about things like valuation too, right? When we think about it and we say, okay, that means the market expects this company needs to have returns recover, not to continue to collapse, while continuing to aggressively reinvest in the business, right? When you are one of the 3 largest players in a space, for you to still be able to grow 8% a year, which, by the way, they need to get Chilean approval to even grow at that rate, which they don't necessarily have, and see returns recover, it just shows you how, on an as-reported basis, you misunderstand a company. Literally, directionally, you're misunderstanding this company's return trend, and valuation-wise, you misunderstand this company.
Valens Research, the world's leading source for uniform financial analytics.